Right now, we have over $3 billion in real estate assets, 300 employees, 10,000 tenants. I'm going to tell you guys the story of how I lost $2.5 million and how that has shaped me to how I am today. At the end of every real estate cycle, there are predictable things, and one of them are condo conversions. So think of buying an apartment building and selling them off individually as condos. Now, it's complicated. There's a lot of legal to it, and you're selling off the individual units independently from what you would pay for just an apartment. So in this instance, we bought a 310 unit apartment building in Scottsdale, Arizona for about $31 million or about $100,000 a unit. At the time, condominiums were selling in the area for over $200,000. So the simple math is buy the apartments for $100, fix them up, sell them as condos, and you have a lot of room and a lot of profit there potentially. We bought the apartment building with traditional financing and what's called a mezz piece or a mezzanine piece, which is essentially hard money that reduces the amount of equity that you're going to need. For us, was only about $2.5 million. So we did this entire deal for $2.5 million, but we had a mezzanine piece plus a senior piece, which meant that it was highly levered. So this would have been 20 years ago. Now, I had successfully done this on several projects in Las Vegas and in Portland, Oregon, and in Arizona. So this was just one more deal in the cycle. We had already successfully made a lot of money using this strategy before. So when you begin the condo conversion business, first there's all the legal, then you have to do all the work, and there's also sales. So I created companies to do all those myself, and I had my own company called Condo Realty Advisors. I also had another company called Investor Management Services. So I created a brokerage company to sell the condos off, and I created a management company to manage the condos for the investors. So we were getting investors to buy the individual condos. We were doing all the renovations, and we were selling the condos to the investors. And then we were also selling a property management package at the closing. So because the property was highly leveraged, we had to sell about 230 units to get into the real money. In other words, when you have the senior debt, the mezzanine piece, plus the equity, and you calculate it times the per sale per unit, the break even was about 230 units. So once we got to about 230 units of sales, then the rest is all profit. Then the great financial crisis hit, which was about 2007, 2008.
What in the world is happening on Wall Street?
Two-year no yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
Which hit us right during the middle of this project. So the first thing that happened during the great financial crisis is the credit markets pulled back. So the investors that had previously said, I want to buy this condo, could not get any financing. So instantly, we were sitting with a bunch of product that had been renovated that was supposed to be condo sales that actually couldn't be sold off because the credit markets constricted and the investors couldn't get any debt to buy those units. So my partner and I were sitting on about 150 unrenovated units and about 75 renovated units, and we had sold the balance. When the credit market stopped, we immediately realized that we weren't going to be able to get to break even. So we started talking to the lenders. The only recourse we had was to start renting those units again. Now, don't forget, we started with a rental project and we're selling them off one by one. When the credit market stopped, our plan B was to rent them out. The problem is the rents at the time didn't nearly cover enough of the expenses. So at this point, it was just a matter of time. We saw that the credit markets were not going to come back, and the great financial crisis only got worse, as we all know now. So essentially, we ended up having to give the keys back to the bank to the lenders that were in place in the first and the second position. Then I had to make a call to our investors. So Ross, my partner, and I, we both lost $500,000 each, about $1 million, and we had raised about $1.5 million more from some friends and family, the traditional syndicated model. I had to pick up the phone and let them all know that the deal was now dead and we were turning the keys back over to the lender. Well, I think the first thing is you got to be fully transparent with the people that gave you the money, right? That's the biggest thing. You got to make sure that your palms up with everything and everybody and just saying, listen, and having a conversation with everybody. That's super important. Many of those investors continue to invest with us because, we had made them a lot of money up to that point, and this was the deal. This is the last deal I lost money on, and it still pisses me off. But the lessons were invaluable. So this is precisely why I pulled back in the last 3 or 4 years, because I saw the same things happening. Some of the red flags that I started seeing a few years ago were the exact same red flags that I should have seen, but I didn't have the wisdom or the experience to see back in 2007, 2008. So after we licked our wounds and we watched the great financial crisis actually get worse and take more and more and more property, not just ours, from a lot of our friends and people that we knew, as the bank started loading up, I realized that the bank actually is the one that had the problem, because banks are supposed to own real estate. And so we started going to banks and said, how can we fix your problem? What can we do to take these toxic real estate assets off of your books? And that's when we started cutting deals. The problem was none of the banks would lend and none of the investors would invest, because not just in our deal, everyone was losing money. So that's what I thought. How do I fix this problem for the banks? How do I go somewhere else like Canada and raise some capital to be able to buy toxic assets in the United States? Because what I realized is just because that was going on in the United States doesn't mean that it's going on anywhere else. And that was certainly the case, because in Canada, the economy was booming. And from their standpoint, it looked like the USA was on sale. You have to get burned at some point to be successful, in my opinion, because when you're making money, you're actually not learning anything. You think next year is going to be better than last year. And so that's precisely what I just witnessed with a lot of the people that are having pain right now in today's real estate market. And this is precisely why both my partner and I, Ross, pulled back. It's because of the lessons that we had in 2007 and 2008. You have to go through those pain points, because when a lender wants their property back, they start pulling out the loan agreements, and you start to look at the things that you signed so easily while the market is going up and it isn't going up. That's actually when you start to learn the most. So obviously nobody wants to lose money, but we did. And the last thing I wanted to do was do it again. So now both my partner and I, every single time we get a deal, we're like, okay, what did we miss? Now we're questioning ourselves even more. Even though we're wiser and we have more experience, probably better decisions than we were 20 years ago, all we've really done is reduce our risk. So the whole condo conversion model has risks. It has risks when the credit markets go down. With apartments, which is what we decided to stick with, once we lock that debt in, that long-term agency Freddie or Fannie debt for the long period of time, and we know what our mortgage payment is for a long period of time, and we buy in a good market, and it's a rental market that's progressing forward, more and more people want to live in that market, and then the population growth in that market is going up. All those things mitigate our risk. Once you jump outside of those things, it can oftentimes increase your risk. Once you're relying on the consumer, you actually have higher risk. For us, we pivoted and went back to our original model, which got us up to that point, which is just buying long-term cash flowing real estate that has great tax benefits and lots of cash flow. When we decided to move out of that, that's actually when we got burned. Even though we made a lot of money for about 3 or 4 years doing that exact model, at some point, the music stopped and there were no chairs left for us to sit in, us and everyone else. And that's exactly what just happened in the market right now. For a lot of current syndicators are in that exact same spot. So we haven't bought anything in the last 3 years because everyone that bought in the last 3 years overpaid with expectations that things were going to be more expensive than they are. But now we're seeing a lot of distress with most properties down over 30%. So while we've had our cash on the sidelines, our plan is to buy over $1 billion in the next 18 months. You've got to check out exactly how we're going to do that here.